AM 1170. The Answer.
Welcome back. You are listening to Whissel Wednesdays here on AM 1170. The Answer. My name is Kyle Whissel, your host with Whissel Realty. Joined as always by Mr. Jason Hall with Team Home Loans.
Good evening, sir.
Got a couple special guests in studio today. We got Habib Abbas with Zifit Infrared Fitness. We're going to get to you in the next segment. But right now, wanted to talk with Rainier Trinidad, Parabolic Asset Management. Before the break, we were talking about the election, all these crazy candidates, everything that's been going on. We're literally 6 days away from finding out who is going to be the new commander-in-chief of our country. Rainier, what does this election mean to the financial markets and kind of the direction that our country's going?
Well, right now, the financial markets want, more than anything, they want some kind of certainty. And with the email situation happening with Hillary, it increases the probability of Donald Trump getting into the White House. And the markets don't like that.
So within less than a minute, the market dropped 150 points or something, right?
Yeah, I took a look at the market, walked away, and came right back, and all of a sudden we had this nosedive, and we haven't stopped falling, really.
What should we do?
So what the market's saying that they don't particularly want Donald Trump in the White House because his idea is to rip up all these trade agreements that we got.
Uncertainty. He wants definitely change, right?
Yes.
He is definitely the change candidate.
That's right.
That would change many things, good or bad. We don't know what's going to happen, but definitely the certainty point, like you're referring to in the markets, there would be no certainty, right?
That's right. And uncertainty usually causes the market to go down. Now, if we had Hillary come in, she is for the status quo, and I think that would make markets a little bit more comfortable. The expectation is that if she goes back up on top, then the markets will probably have a rally in the short term.
And that typically happens, right? Once the president gets in and it's done, there's always a little rally right after the election?
Yes, because you have that uncertainty being wiped out.
Okay.
And then what we have going forward after the election is the Federal Reserve, and the market's saying that there's about a 75% probability that they will be raising interest rates again.
Right, this year.
So that's also going to be another reason that the markets will stay volatile until the end of the year.
Okay. So what can we do to protect our money?
Okay, well, this is something that I've been doing for a lot of clients. I like to have a fairly even balance between what they've got in the stock market and what they have in the bond market. Let's say, for example, a 50-50 split, 50% stocks, 50% bonds. What you have with a portfolio like that is something that can handle a lot of volatility, and it typically has maybe less than half the downside risk of a pure 100% stock portfolio. The returns are a little bit lower, about historically going back the past 40 years. Your returns are only going to be about 1% lower per year on average, but in exchange, your downside risk is reduced by half.
So that's when you're in the 50-50.
A 50
bonds,
split.
50 stocks.
Yeah, if you had an allocation like that, you could probably be just fine for the next few decades. The nice thing about an allocation like that is that over time, you tend to do pretty well. Now, a lot of people are scared of the stock market because it's fresh in our memories about 2008, the financial crisis. What people don't realize is that if you had a 50-50 allocation, if you held that for at least 5 years, there was no period over the past 60 years that lost money.
So you would have actually kept what you started with?
At the very least, yes. The lowest return that it made was only about 1% a year. In the worst-case scenario, that includes the dot-com bubble popping and the 2008 financial crisis. So having a little bit of bonds is a very good stabilizer in your portfolio, and that's what I've been trying to get clients to do right now, is just play a little bit more defense. I love the sports analogies here. The thing that wins games here is defense, not only in sports but also in investing. So I recommend playing defense, and that helps you avoid some of the bigger disasters down the road.
So it's not when the market's going to... We know the market at some point there's going to be a big correction again. Right?
Absolutely.
It always happens, right? It always moves up. It always moves down.
That's right.
And if you could predict exactly when it was going to happen, you'd be a multi-billionaire and possibly running for president.
Well,
right?
That would be nice, right? Yes. And putting out a lot of tweets.
Yeah, I'm putting out a lot of tweets. But that's one of the things you do as a planner is you try to plan how can we be ready so that you're not impacted when those market churns come.
Yes. So one of the things that I look at, I have a little bit of a unique background. I've been managing investments for 17 years, and for 10 of those, I was co-managing a hedge fund. It was a $50 million hedge fund whose claim to fame was that it made money in the 2008 financial crisis.
Wow.
One of the things that I'm looking for right now is the trend of the market. We have over 100 years of evidence to back the idea that you can help prevent taking part in these big disasters that happen over time just by looking at the trend of the stock market. If you look at where it's gone for the past 12 months, what we've seen is that since most investors collectively behave like a herd, if the market is up over 12 months, it's likely to carry on that momentum for another 12 months.
Okay.
But conversely, if the market's down for 12 months, that same momentum will carry again for the next 12 months.
So why does the market act like a herd? What does everybody kind of do? Because I know Warren Buffett's big statement is always, hey, when they're selling, I'm buying, and when they're buying, I'm selling.
Right.
He goes against the herd.
That's right.
But why does the market act like a herd?
I think it's because we're too plugged into the media. It's hard not to take a look at the news. It's hard not to listen to Jim Cramer. It's hard not to see what your friends are doing. People take comfort in doing what other people are doing. And so if you or Bob,
if somebody made 10% on this market, you want to jump in. Like when Tesla was on fire, everybody started jumping in.
That's right. Everyone's talking about it, and you want to be part of it as well. And unfortunately, it's when people start following everyone else that you end up doing pretty poorly. You end up getting in near the highs when everybody's excited, but also at the same time, if people get very pessimistic or very scared, you end up selling it out.
Let me ask you this.
Sure.
When should you start saving for retirement, and how much? I mean, I know that's a question you probably get asked very often as a financial planner.
Yeah.
But is a guy at 46 years old, is it too late?
It is not too late. In terms of when you should save, you should be saving anytime, as soon as possible, or as the case may be for a lot of people, in their 40s or 50s, you can still do it right now. The idea is you want to be setting aside probably about 15% of your money and putting it towards a 401k or an IRA. And the ultimate goal that we're aiming for is to save 8 times your annual income. That is the magic number. 8.
So that's how much you want.
Yes.
So if you make $100,000 a year, as an example, you need to have $800,000 in the bank.
That would be the ideal goal. Yes,
you would have $800,000 in retirement.
$800,000 in your
not in the bank.
$800,000 in your
retirement investment account.
That's correct.
I've always looked at the bank, Jason, as all right. So every dollar that I have, I look at as an employee.
Yeah,
and I look at my bank account as the unemployment line. That's always been my theory in life. If my money is sitting in the bank, it's not working for me.
Right. You want to put those dollars to work.
I want to employ those dollars.
That's right.
But you need a nice little 6-month nest egg is always good. So I can have 6 months worth of employees sitting in the bank. But outside of that money's got to be out there working.
That's right.
So 8 times, and then that 8 times is going to pay you what, roughly?
So, the 8 times is based on the assumption that when you retire, you will only need about 80% of your annual income to continue.
And that is because?
Because you will have mostly paid off your mortgage by then, and some of your expenses, like all your cars, they're all paid off. You don't need to be commuting. You don't need to be driving or buying new cars and so forth. So that's where that assumption comes in.
Okay.
Now, once you retire, the general idea is that Social Security will cover about 30% of your annual income. So what you're
But
left...
if Hillary gets in, she's going to take care of me, right?
No comment.
Good
Once you have gotten to retirement, you only need about 80% of your income, and 30% of that will be covered by Social Security. So you're left with having to cover the other 50%. And the numbers suggest that having 8 times your annual income, that will allow you to live off your retirement savings for probably like the next 17, 18 years or so, which is the which would get us to about our typical lifespan.
All right. Now, I know we have a lot of millennials in studio and listening right now. When should they start? And I know historically you should start sooner than better because you could put in less, right? You can be happy to put in $100 a month when you're 20 years old, but when you're 46, you got to be putting in like $1,000 a month.
It will increase. The sooner the better, and it's really just about establishing a habit and being able to live less on less than what you're taking in. A lot of people like to go save their investments and put it aside, and that's great. But actually, one of the things that you can do is to pay off your credit cards. Not a lot of people look into that, but those credit card rates are averaging about 18%. And there's nothing in the stock market that's going to give you an 18% rate of return. So one of the fastest ways you can move ahead is to get rid of that debt as much as possible.
Because that technically is an investment.
It is.
Because you're putting money in the bank. Like my wife, did this for a while. She's like carries these balances on our credit cards, but she's got money in savings. And it's like, that doesn't make sense.
Right. You're getting like 0% basically
negative
and paying like, say, 10 to 12%.
Yeah.
Exactly. It's a negative return on investment. You want to eliminate that as much as possible.
I love it. So again, we're talking with Rainier Trinidad Parabolic Asset Management. If you want to get connected with Rainier, get some advice on what you need to do to secure yours and your family's financial future, give us a call, shoot us a text, 619-663-SELL, 619-663-7355. We're going to head to break, but when we get back, we've got your financial picture figured out. Now we want to get your physical picture figured out. We're going to talk with Habib Abbas with Ziffit Infrared Fitness when we get back here on Whissel Wednesdays.
AM 1170, The Answer.